So you want to look at materials or utilities? I think materials is probably a good one to look at.
That's probably a good one, isn't it? Yeah.
So let's have a look at materials, because that's what we're talking about, BHP, Rio,
Utilities
those sorts of
has
stocks.
sort of come back, is not looking the best, but that could be an opportunity during the year, the utilities. So we can talk about that later on during the year when that reverses and comes back up again.
There we go.
So we've seen a nice big run in materials, obviously, with BHP, Rio moving up. And there's a bit of a difference in consensus out there in the marketplace as to whether one's better than the other. But I say, look, just pick, if you prefer BHP over Rio and you're looking at how to set up your portfolio, you can either consider to buy both if that's the strategy you're looking at, or you might just say, well, okay, I'm just sticking with one and have some more diversified mining-related stocks in your portfolio at the same time to have a better spread and exposure to certain areas.
Fortescue, though, that's been the I suppose the poor second cousin to BHP and Rio. And
but only lately, though, which is interesting. So, you know, that'll have its day in the sun again. So I'd be watching that as well this year. But at the moment, as you can see, it looks like the sector's turning right on that turn date. And we've got a date there in January 2018 on the chart. Yeah. The next date is July 2018, which can often be quite volatile because the portfolio managers, the big fund managers, are juggling their placements or their selections for the year for the funds, and so that can create a lot of volatility in July and sometimes a lot of upside on the market.
Well, it is in the new financial year, so that's where they're adjusting it. So, but you're looking at what Janine was talking about here. If you see the screen there, you'll see currently the materials opened at 11,584 points for this month, but currently it's closing 11,668, so only slightly above where it opened. But both of those open and close are at the bottom lower end of that bar, roughly where my pointer is. So you can see how it sort of moved up, tried to get through that level that with that horizontal line that you see, but it's now come right back below it and sitting there. And that's where Janine's saying so we might get a month or two down on this.
Yeah, look, I was actually hoping that we'd get to about 13,000 points by around this time, and I thought it might go up a little bit faster than what it did. It was really, really excited by the move that we saw in December, and I thought we might sustain that into February, but we've actually turned a little bit earlier than I expected. So that's okay. You've got to appreciate how far it's come already, and then look at the fact that we could have a little bit of soft, selling off, short-term selling. The profit takers come in, and then another move up during the year to that next level.
So what sector do you want to look at now, and then we'll go and have a look at the Dow and the Aussie dollar?
Look, I think telcos for now, even though Telstra has always been, has been in the last couple of years a bit of a dog stock, using your words. And I know that, from time to time Telstra's had good runs, but then probably the best run that we saw was after that low in about 7 years ago, and now we're looking at a potential move on the monthly chart there. And once we see a move above the trend, so there's a trend that's quite strong all the way down, and we've seen it move to that 1,200 point zone. We just need to see a bit more confirmation. As I said in the last report, a turn around this time of year was expected, but we still haven't seen huge strength. And I think what's happened is that speculators have seen the sector make a bottom and do a bit of a reversal, and they've jumped in before confirmation.
Correct.
And it's come back. And I've seen this happen on some of the healthcare stocks as well, so something to be mindful of. Just wait for that confirmation, because a stock like this, if it does get on a run, then we're going to see a decent run out of it. And after we've had so much war and from the GFC, we've had the market correction, we've had all this war going on around the world, and then we could be into a time where technology starts to move, and that's what I'm looking for. And I know that Telstra came out with talking about its advances into technology. So we need to see something significant from Telstra to really drive that share price higher, and that's what I'm watching for at the moment.
Well, it's been going down for 4 years or something. I mean, it's high back here. Where's that back in 2000? I've got to get my glasses on again.
15,
February 2015. So it's been going down as long as the banks. So, and that's why, at this point in time, we do need to see, as Janine's saying, as confirmation. And often you'll see like what we'd call a dead cat bounce. It moves up a little bit, and that gets some early speculators in, but then it comes back to where it was before. So
people want to buy and hold these types of stocks like Telstra for the dividends, but you can see in this scenario that it really is not, it's a false economy to be thinking that way. It's a really good trading stock, and the monthly chart there shows you that nice trend moving up and down.
Well, you could have bought this stock back 5 years ago for the same price it is today, and then you could have gone back another 5 years and still bought it at the same price. So,
Nice to have a crystal ball,
but
isn't
in
it?
between, it does make some really, really nice runs. So right now, Telstra is probably a little bit too early to buy. As I said, we're probably thinking it's going to come back a little bit, and then once it breaks through that downward... get this thing off my screen. This is basically, it's not a valid trend line on it at the moment, but we're looking for a third point on this trend line, and we'll probably get it maybe in the next month. But once it breaks through that solidly, then it'd probably be a nice place to pick that sort of stock up from that point, like a Telstra, because the sector's moving up, and Telstra is really that sector, pretty much, isn't it? The other companies are a bit small, but then go and look at the Telstra chart and say, okay, well, it's probably leading this move through there and picking it up, but then it I wouldn't suggest not to take on some of the smaller telcos either at the same time, because they may be starting to move up with Telstra as well for the same reasons.
Yep.
So
TPM is a good example.
TPM. Oh, okay, fantastic. So now you want to go and look at the Dow Jones or the Aussie dollar?
Dow Jones would be great. Okay, Dow Jones. Now, looking at the chart there, we know the Dow has had an extremely strong rise, and looking at the times I had for the turn, you can see I had a turn there last year. I was expecting the market to make a significant turn there, but it didn't. So it would actually powered through it. Now, some of these turn lines, the market will turn spot on or a month later, and sometimes you'll find that the market will just push straight through, which it did in that case. So and it went through numerous levels. 23,000 was a level I had there. 25,500 or 25 to 26, I thought the market would turn. It's just been extremely bullish with all of the talk about the tax cuts in the US. So we've seen the market push up, and my next level there's 27,000. So it's quite possible for the market to get to that, although we're seeing a bit of a slowdown potentially starting now. 28,500, 29,500 Dale.
Which is that top level.
Yeah, so there's really that zone around that 28,500. So that's what I'm expecting that the US market will do this year. Now, we need to see what happens over the coming months. The Fed's talking about 4 rate hikes this year. And so in the marketplace, they're now factoring all of that in. And I think we saw this week a bit more volatility on the US market, a bit of a sell-off.
We have actually, yeah,
and,
very much so.
Yeah, and I think some of the reports were attributing that to what's happening in US reporting season, but I don't think that's it alone.
But it's been a reasonable reporting season.
It's been a really good reporting
season. There's no real
and
reason
that's
for it to
helped
be
to
volatile.
drive the market, as we've seen. Okay, so if we go back to 2014, you're going to see a lot of blue bars in that area. It's a sideways move on the US market, and then a decline of around 16.5%. Now, around that period, 2013-14, there was a lot of talk by the Fed about rate hikes. And when the Fed starts to talk about successive rate hikes becoming more of a certainty than anything else, that we then see the market have a bit of a slowdown. So that's what I'm expecting this year, given that they're talking about potentially 4 hikes for the year. So we may see the market move up into the zone that I'm talking about, and then we see a bit of a slowdown. It could go slightly through it to closer to the 30,000 point mark, but it may come back. Now, the risk is for the market, how far will it come back? Now, typically, if we look back over history, we can see short-term declines of a month or so that may be anywhere from about 3.5% to 7% or in that order. But then when we're talking about a more significant correction, which is we're expecting that, we think that the market over there is overdue for one. And I pay attention to some of the reports, and I don't spend a lot of time listening to reports about the US market, but when they start talking about that the market's due for a correction, then I'm paying a little bit more attention to what's going on. And so I'm seeing that happening now and watching how that's all going to unfold. So we could see a bit of a sideways move, a bit more volatility before the market has it. Possibly a correction in the order of 10%. Now, if it keeps going up to the top end of that target, then we're going to see we're more likely to see that bigger correction coming.
You're going to see more like that 10 to 15%. But we're, as you were saying earlier, we're actually due for probably a bit bigger pullback on the Dow, especially because if you're looking at it right now, I mean, if you look in the chart, it's more vertical the price. So
and we're so far away from the trend.
Yeah, we're way away from the trend, and you can see that the trend line on it, in theory, it should come back to that trend line. Now, the reason why, if they're talking about rate increases, the reason why that slows the market down is because putting money in cash, in risk-free cash, becomes more attractive, and so therefore less money will go into the market to get that growth.
And they're talking about money shifting to bonds, so there's a lot of that discussion going on, which I don't buy into that too much, but I would really just watch what they're talking about in terms of whether there's going to be a correction or not, and see if that starts to get louder.
In terms of how we talk about the Dow Jones in terms of managing portfolios, now I know I get a lot of calls from people saying, I want to buy US stocks, I'll move into the US market because there's more opportunity over there. And my statement to a lot of people is saying, well, you know, have you ever seen a kid in a lolly shop? You know, and more choice doesn't mean better. And the research I've done for my new book, which will be out in about March or April here in Australia, and then and I've done the US stocks as well, which will probably be mid-year for the US, is that for somebody in America, buying US stocks makes sense. And in America, they talk about buying offshore, investing offshore into other markets because you'll get a better return. But in Australia, we do exactly the same thing. If you're in Australia and you're buying Australian stocks, you'll do far better than going to the US and investing offshore. And statistically, it's the same thing.
Over the long term.
Over the longer term, and it's statistically proven that you shouldn't necessarily, or you don't need to go to overseas markets to get a better return. Actually, it makes sure it diversifies your return by moving into those markets, because you're adding another variable in terms of the Australian dollar and the exchange rate against the US market at the particular time. And a lot of people are making that mistakes because now brokers are allowing people to buy into the US market.
But it's a question of when they do it as well. Because they're
absolutely
more likely to do it when it's already done.
Correct.
The market's already run.
And that's what we were talking about a bit earlier, whereas buying doom, not boom, we're at the point of now. And yes, our market will slowly at different times match with the US market, but we tend to struggle. Like our market will outperform the US market, and next minute the US market's outperforming ours. But over a period of time, it all balances out. And so making your investing more complex by going into other markets like the Dow or the US market or the European markets or even the Asian markets is not necessarily going to give you a better return. It's just going to make your life more complex. And so to me, it's about sticking to looking at these big stocks in Australia and looking at how you'd construct that portfolio within Australia. You don't really need to go overseas to get good returns. In fact, you'll get better returns by staying in Australia.
Over the long term.
Over the
and
long
Russell,
term.
there's an ASX report that comes out
Yes.
and talks about it over the 10, 20-year period. So that's really interesting to
Well, I was only
follow.
reading that the other day, actually, on the US market and against world markets. And it consistently, our market and the South African market are the best performing markets over the last 100 years. I'm not sure why you want to go anywhere else anyway, but you know, people like the romantic idea of buying Apple or Microsoft or, you know, GM, or not GM, that one went into Chapter 11 during the GFC, but you know, other big stocks like Hewlett Packard, those sorts of ones. But right now, I think there's more opportunities in the Australian market than in the US market for anybody. So let's go now look at the Australian dollar against the US dollar. So I'll just bring that up. I've got to put my glasses back on again. It's terrible when you get old, isn't it? You've got to do these sorts of things.
Now, I think the Aussie dollar's surprised a lot of people over recent times. And I guess for me, the way that it's unfolded was really interesting, because after it met that bottom in 2016, I was expecting a bit of volatility in the sideways action, but I wasn't expecting it to stay in the sideways pattern for as long as what it did. And look, it has finally achieved the level around $81. Well, it did so a few months ago. You can see this month it's come back again to that level. And now, looking how strong the Aussie dollar is, it's got the potential to go to my next level. So I've got 84.5 cents and 87.5 cents. Now that when the Aussie dollar gets to that level, that can cause a significant shift in the economics or the economic equation, especially for the import-export market, and that will have an impact in Australia. But I just think it's interesting how our dollar. People don't think that there's a possibility of being able to look at the dollar and see repetition in how it unfolds. But if you just show them the whole history that we have there on the chart, you can see that roughly every 7 to 8 years, the Aussie dollar does make a significant low. And we've seen that low come in. We believe now that the dollar's risen as strongly as it has. So we've got some history there.
So these are these sort of bluish, greenish shaded areas. So you're seeing how it has repetition there. And it does. It always has. And we've only got data back to 1990 on this. the Aussie dollar, we can measure back further than that. But right now, every market has its own time in the sun, and it also has the time when it's in the doghouse, so to speak. But right now, I'd agree with you. The Aussie dollar is looking quite nice against the US one.
Now, it's not to say that the currency couldn't turn and fall away, but if it did, then a strong sign or a trade below that 75-cent mark would be the indication that we were going the other way. And those levels, as we talk throughout the year, will probably raise those stops, if you like, as to where the dollar is more likely to be on the downside than the upside. But right now, it's looking really good. It's broken quite a strong level, and it could trade through that prior high in the short term and head towards those other two levels I was talking about.
So looking at companies that are exporting is when the high Aussie dollar, it will actually affect their revenues from that point of view. But also what you need to be looking at is companies that will benefit from a higher Aussie dollar, and that could be travel, tourism, those sorts of companies, because people will travel a little bit more. So ones like your flight centres, that people are booking flights to go overseas, especially more to America, if it's high against the US dollar. So that sort of stuff you need to be looking at. So obviously retail sales in terms of buying online, that sort of stuff. It's also happened when we had a higher Aussie dollar back a few years back. You might remember about 6 years ago, it was 6 or 7 years ago, it was parity. So a lot more internet buying was happening. So therefore look at companies that will benefit from that within Australia. That might be courier companies, that sort of stuff, transport, logistics, those sorts of things. So that could be things like Cube, some of the other types of transport stocks, etc. So
transport stocks can be very hit and miss.
They can, can't they?
I mean, they still have good patterns over them, but you really have to watch those shares. They can be a lot more volatile for that reason, because they are affected by things like the energy side of things and the currency. So that's a good point.
Okay, so let's wrap it up. Now, if you're serious about trading and you want to learn how to profitably trade our share market, check out our educational courses on our website, wealthwithin.com.au.
You can listen to our Talking Wealth podcast that Dale and I do every week about all investing, ranging from stocks and shares to dividends, commodities, superannuation, and a whole lot more. Check out our Talking Wealth podcast on Soundcloud.
We'll be breaking down the sector in the Australian and US markets once a month and analysing it, so leave a comment on which sector you'd like us to cover first.
Thank you very much for watching this video. We hope you've enjoyed it. Leave a like on the video if you enjoyed it, and subscribe to get notified when we upload new videos.
From myself and Janine, goodbye, good luck and good trading.
Bye for now.